In today's video, we'll be talking about depreciation. And let's take note, depreciation is governed by IS 16, which is property, plant, and equipment. So we'll move on to the definition of what depreciation is. So depreciation is defined as the systematic allocation of depreciable amount of an asset over its useful life. So depreciable amount is the revalued amount or cost of an asset less its residual value or scrap. So for us to be able to estimate the useful life of the asset, we need to consider the following factors: the expected physical wear and tear, obsolescence, and legal or other limits on the use of the asset. When we come to the method of depreciation, we have several methods. We have the straight line, we have the reducing balance method, and other several methods. But for the purpose of this video, we are going to look at only straight line method. So straight line method is where the depreciation results in a constant charge over the useful life of the asset. So the formula for the straight line method is cost minus residual value into brackets scrap value divided by the useful life of the asset. We will take an example. Asset we have two examples, right? We have asset acquired at the beginning of the accounting year. So the question goes, a company bought a plant costing $22,000 with estimated life of 5 years and a residual value of 2,000. What is the annual charge to the P&L for the first year? So let's break it down. The formula says cost minus residual value divided by the useful life of the asset. So we see the plant cost 22,000. We can see the residual value of 2,000 and the estimated life of the asset being 5 years. So when we insert it into the formula, we will get $4,000 per annum, which will be charged to the P&L. So assuming the question was asking us to calculate the monthly charge of depreciation to the P&L, then in that case we would have divided the 4,000 per annum by 12 months so that we can get the monthly charge that will be posted to the P&L. So always you have to look at the question, what the question requires of you to be able to answer it correctly. The most important thing is for you to know the formula. So we will move on to the second scenario where the asset is acquired in the middle of the accounting year and with the assumption that the company's financial year is starting from January to December. So the question is, a company on the 1st of May bought a plant costing 22,000 USD with estimated life of 5 years and a residual value of 2,000. What is the annual charge to the P&L for the first year? We can see that the figures are the same as the first example. The only thing changing here is that the plant was bought not on the 1st of January. So in that case, when we insert the figures and we get 4,000, that will not be the correct value for the year, which will be charged to the P&L. So for us to get the correct value or amount that will be charged to the P&L in the first year, we need to multiply the $4,000 by 8 divided by 12, because from May to December is 8 months. So we divide 8 is divided by 12, and then we multiply it by the annual, which is the 4,000. And in that case, we will get 2,666 for the first year. So these are the two examples that we will consider in this video. And note that when we talk about depreciation, someone might be confused. What is the difference between amortization and depreciation? And under IAS 16, the depreciation is only for tangible assets, right? And then amortization is for intangible assets like goodwill, like patent. So let's be clear on this and not confuse the two. So this is how the journal entry will be made. So we can see that the expense accounts will be debited because this is a T account. So the left side is debit and here is credit. So with our depreciation example, this place will be debited and then accumulated depreciation will be credited. Accumulated depreciation is credited because this will reduce the cost of the asset at the balance sheet. So that is why we have the credit. And even apart from that, the double entry of accounting expect us that each transaction should have a debit and a credit. So since depreciation the depreciation expense will be reducing the gross profit to get a net profit. So we debit the expense has a debit balance, so we debit and then we credit the accumulated depreciation so that it will reduce the cost of the asset at the balance sheet. So this will be all for depreciation. So I will see you in my next video, and please do well to subscribe to my channel and like, and also comment in the comment section if you have any topic in mind that you want me to treat. Please put it in the comment section and I'll do just that. So I'll see you in my next video. Bye bye.